Hello, Steve Lentz here with Discover Options. Welcome to this presentation of several different market timing reports. This is for Friday, September 8th, getting ready for Monday, September 11th. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, we have three reports. The S&P 500 Condor Butterfly Timing Report answers the question, is now a good time to put on in the SPX a Condor or Butterfly campaign? The Bull Put Spread Timing Report answers the question, in the SPX, is now a good time to put on a bullish Bull Put Spread position? And then finally, the SPX Directional Likelihood Report answers the question, based upon past occurrences of the current market condition, where is the market likely to go in the next 5, 10, and 15 trading days? Okay, before we get to those reports, I want to ask you to subscribe. Just click on the subscribe button. We'd love to have you get alerts whenever we come out with new videos. And then also, if you have not received our free ebook, click the link and we'll get this to you. Just give us your information and we'll get this right out to you. It's a Simple Steps to Options Trading Success, co-authored by Jim Graham and myself, Steve Lentz. Okay, let's look at the current market condition right now in the S&P 500. We are above the 50-day simple moving average. The long-term trend is technically up. And in terms of price action, we had an inside bar on Thursday, and then Friday was a downswing bar where we had a lower high and a lower low. All right, now that all happened with the 15-3 stochastic being right around 75 or so. It's between 50 and 100, and it's technically below its %D, below that 3-period moving average of %K. So all this is a fairly unique market condition when you put all three elements here together: the trend, the price action, and the stochastic situation. Okay, and this situation has occurred roughly around 60 times since January of 2000. So it's not quite the population that we would like, but we're going to report on the results anyway, and you could hopefully use this in your trading. The Condor Butterfly Timing Report. So since January of 2000, we've had around 4,466 daily closes of the SPX. Now, of these, 65.7% have been favorable bars for selling premium, option premium, where the actual subsequent 21-bar movement was less than what was being implied by the SIBO skew-adjusted VIX. Okay? And so, again, 65.7% were favorable. So you could flip a coin, and roughly 66% of the time, roughly 2/3 of the time, you're going to pick a day where it's favorable for selling option premium using condors and butterflies, using that definition. Now, also during that time, since Jan of 2000, our current market condition has occurred roughly 61 times. Of those 61 occurrences, 72.1% of those bars were similarly favorable for selling option premium through these strategies. So this implies an option premium selling edge of roughly 6.4%. So we have a positive edge as of Friday. Okay? Statistically, it's more likely than normal that the current market condition will end up being favorable for market neutral option premium selling strategies like this. Okay? So that's the Condor Butterfly Timing Report. Now, for those of you that like to do bull put spreads in the SPX, this report assumes that you're going to go out a standard deviation into the puts, out of the money, roughly 30 calendar days out, 21 trading bars. Okay? So, since Jan of 2000, we've had 4,466 daily closes. Now, of those, 83% of those were favorable for selling put option premium, a standard deviation out of the money, where the actual 21-bar downside movement was less than what was being implied by the SIBO skew-adjusted VIX. Okay? So, I hope you understand that, all right? So you could flip a coin, and 83% of the time, your out-of-the-money put would not get struck. You could sell that put, and then, of course, buy one further out to cover it like a bull put spread. But that short option would not get hit in the course of that 21 days, 83% of the time. Now, we've had 61 occurrences of our current market condition. Of those 61 occurrences, 85.2% of the bars were not struck. That implies an edge of roughly 2.2%. It's a wash, basically, but just a slight edge, where now of the 61 occurrences of our current market condition, 85% of the time, the market did not go down and hit it. Okay? Statistically, it's slightly more likely than usual that Friday's bar will end up having been a favorable one for selling out of the money put premium. Okay? All right, so that's the bull put spread timing report. Let's look at the likelihood report. This answers the question, based upon past occurrences of our current market condition, where's the market likely to go? Up, down, wobble around for a bit. And to answer that question, we have to use what I call price distribution bands. Price distribution bands. And I set my screen up to show 6 of these, 3 above the close and 3 beneath the close. These bands are set 1 standard deviation away, 5, 10, and 15 days out. And we just want to notice in the past of all those closes of the 4,466, how often do the upper bands or the lower bands get struck over the subsequent 5, 10, and 15 days. So I've set this up with bands, and you can see up here that these are the 6 bands recorded here. But let me go and show you an example. This is the best way to do this. So here we have the close. This is just an example from a while ago. We have the upper 5-day band set up here. The lower 5-day band set up down here. Notice that the upper band is closer to the close than the lower band. And that's because we are using a skew-adjusted implied volatility from the VIX. And the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts. So that's why these bands are set up asymmetrically like this. And the question is over the next 5 days, will price go up and hit the upper band or go down and hit the lower band in the next 5 days? And so we've set these up to reflect the 5-day bands. We have 10-day bands, and we have 15-day bands. And for every close, we record whether price struck any of these bands. And so here are the results that you can see up at the top. Here's the historical distribution for the 4,466 occurrences. The upper band was struck. The upper 5-day band was struck roughly 21.3% of the time. The upper 10-day band, 15.7%. The upper 15-day band, 14.7%. The lower 5, 16.6%. Lower 10, 16.8%. And the lower 15, 19.6%. So this is the benchmark numbers. These are the benchmark numbers. Now, we had 62 occurrences of our current market condition, and of those 62, the upper band was struck 12.9% of the time, which is substantially less than the benchmark. Hence, you have this red number down here. You see that? In fact, all 6 of these bands were struck less often than the benchmark numbers. Do you see that? That's an indication of lower market volatility. Lower market volatility. Now, we like to break this out so that if you get going on Monday and price goes, say, above Friday's high, well, what I'd like to do is just to examine the distribution in that case. When it goes above the high on Monday, what is the price distribution in that situation? And so in the past, we've had 25 occurrences where the previous day's high was exceeded, and in that case, 5 of the 6 bands were struck way less often. In fact, look at this. 2 of them were struck, really never struck. 3 of them were struck, it would appear, just once. And then, of course, way over here, the lower 15-day band was struck quite a bit. That's kind of a weird anomaly, but that's, kind of what you get when you have fewer, numbers of occurrences here. And down, if it goes down below Friday's low, We similarly have 5 of the 6 bands getting struck less often. So again, a picture of lower market volatility. Tough to make this a call in terms of leaning it one way or the other, because I think with such few occurrences, we do have 2 of these bands that got struck more often. I suppose you could lean it that way a little bit to the bearish side. In fact, if you had to lean it one way, you could lean it to the bearish only because of that. But all in all, I think the conclusion is you have a likelihood of lower market volatility. Is that guaranteed? Certainly not. You can see that the bands have gotten struck. I mean, look at this. I mean, roughly, 11, 12%, 14%. I mean, the bands can get struck, but it's just less likely given the history of this market condition we have. Okay? Wonderful. Folks, thanks for joining me. I'm Steve Lentz with Discover Options. We'll talk to you next time. Take care. Bye-bye.